I think that they have a decade of good markets in front of them. But I suspect that 2 or 3 times in the course of the next decade that the gold price will fall by 25% or more without derailing the gold bull market. In that case, there's nothing wrong with gold. There's something wrong with the investor. If you miss Bitcoin and you only make 300% in a gold bull market, is your life worse? I think not.
In this video, legendary natural resource investor rickrule offers a clear and grounded perspective on the long-term future of the gold market. According to the discussion, precious metals are positioned for a strong decade ahead, driven by structural imbalances, tightening supply, and escalating global financial instability. But Rule warns investors not to mistake inevitable volatility for failure. He explains that during any powerful multi-year bull market, gold can and likely will experience sharp corrections, sometimes dropping 25% or more. These declines, he emphasizes, do not signal the end of the trend. Instead, they expose emotional investors who misunderstand the nature of long-term commodity cycles. Rule argues that pullbacks are normal, healthy, and often profitable for disciplined buyers. The real danger isn't gold, it's impatience. Even if someone missed Bitcoin, he notes, earning 300% in a sustained gold bull market is hardly a tragedy. The key is understanding that volatility is part of the opportunity, not a reason to abandon the trade. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
A rate cut will be catastrophic for America, wonderful for gold. A rate cut will signal, if it occurs, that U.S. society politically has lost any interest in defending the integrity of the U.S. dollar. I mean, we could talk about real interest rates, but that would be a long discussion. Suffice it to say that the U.S. economy doesn't need a rate cut, although the U.S. Fed may as a consequence of servicing the U.S. debt. But one of the things that has kept the U.S. dollar relatively strong compared to other fiat currencies has been that the nominal interest rate in the U.S. is higher relative to U.S. inflation than nominal interest rates are in other countries relative to their nominal inflation. A real policy of rate cutting by the Fed would signal to the world, as I say, that U.S. society doesn't care any longer about defending the integrity of the U.S. dollar. From a historical perspective, we saw this in 1975. At the beginning of that period, the U.S. tightened the interest rate, concerned about inflation. The gold price tanked, it fell by 50%. When the U.S. Fed lost its nerve at the end of 1975, the gold price went on a tear, an absolute tear. And I mean, as a gold holder, that's not unwelcome. But for the rest of one's life, that's a bad thing. You know, I'm going to go back to speeches I did 25 years ago that have to do with the fact that you have to be extremely selective, but you also have to be extremely patient. One of the things I've learned, Kai, in grading now almost 100,000 portfolios for investors is that most investors own too many stocks. They don't know the stocks that they own well enough. And many investors get the strategy right, but they get the tactics wrong. I looked very carefully at every stock that I'd made 1,000% on or more in my career. I did this study about 7 years ago. But I learned some very interesting things by doing that. I learned that the average 10-bagger took me 5 or 6 years to achieve. It didn't occur in 3 months. And the average 10-bagger, at least once during the point in time I held it, exposed me to a 50% or greater share price decline. Where I really made money is where I had enough courage of my convictions that when the stock fell by 50%, rather than selling it, I bought a lot more. And so I think that investors need to own fewer stocks. They need to have an opinion as to value and future value, rather than focus slavishly on price. And then they need the courage of their conviction. They need persistence and tenacity. And I see that missing in many retail portfolios.
In this video, natural resource investor rickrule explains why a Federal Reserve rate cut would be catastrophic for the United States, but extraordinarily bullish for gold. He argues that the moment the Fed pivots, it sends a powerful signal to global markets. the U.S. is no longer committed to defending the integrity of its own currency. While the economy doesn't need lower rates, the Fed may be forced into it simply to manage the nation's massive debt load. Rule highlights that one of the only things supporting the dollar today is the fact that U.S. nominal interest rates still sit above inflation, unlike many other countries. If that advantage evaporates through aggressive rate cuts, confidence in the dollar could unravel quickly. He draws a historical parallel to 1975 when early tightening crushed gold prices, but the Fed's eventual loss of nerve triggered one of gold's most explosive bull runs in history. He also offers a reality check for investors. Most own too many stocks, understand too few of them, and lack the patience required for life-changing gains. True 10-baggers, he explains, demand conviction, discipline, and the courage to buy when fear is highest. Let's get into the interview.
I am going very far down the food chain now. As you know, Kai, about 5 weeks ago, I sold 25% of my junior positions. In retrospect, that was good timing. I didn't know it was good timing. I just knew that I had very large positions, and if you were going to sell them, you had to use a period of very high volume, and that was a period of very high volume. By selling those positions, I was able to eliminate all my risk. By selling about 25% of my junior positions, I was able to recoup all the capital I spent in the market since 2020, which means I sold 25% of my upside and I eliminated all of my downside.
Fantastic.
What I'm doing now is rebalancing within the sector. My competition is gravitating very much to development stage companies, which they think will be bought out when they achieve nameplate capacity. So that space is getting very crowded. What I'm now gravitating to is the prospect generators and the grassroots explorers that have a drill hole, the discovery plays. Because the discovery plays, in the last 20, 25 days, they've been mashed in the market. What were $60 million market caps are now 30 or 35 million market caps.
Any particular reason for that?
In risk-off markets, the tertiary assets, the riskiest assets, fall the most. It's something I've witnessed maybe 35 times before in the market, and I'm old enough to keep my eyes open to those lessons.
In this video, veteran resource investor rickrule shares a rare look into how he is repositioning during the current turbulence in the junior mining sector. After taking advantage of unusually high trading volumes just weeks ago, he exited 25% of his junior positions, locking in enough profit to recover every dollar he's deployed since 2020. By selling a fraction of his upside, he effectively removed all downside risk, a move he believes investors should study closely. Now, with capital secured, he's shifting deeper down the value chain. While much of the market is crowding into development stage companies expected to be future takeover targets, Rule sees more compelling opportunities elsewhere. Grassroots explorers and prospect generators, especially those with early drill results, have been hammered in the recent risk-off environment. Market caps that once sat near $60 million have collapsed to the low $30 million range, not because of failure, but because fear always hits the riskiest assets first. For disciplined investors, he argues these periods create the most extraordinary discoveries and long-term wealth creation. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.